Great. Welcome to Digital Asset News. My name is Rob, and today there's really two big stories. The first one I'd like to talk about is, as I call it, the Kwon Stablecoin Act and what that means as far as moving forward, as far as stablecoins, and I think some are going to actually disappear. Then also we'll talk quickly about Jerome Powell and his decision to raise 75 basis points. Not really surprising. Then we'll talk about the Voyager auction update. We're going to talk about how Cardano's Basel upgrade is tomorrow, which I think some people have actually forgotten. And then also we'll talk about tomorrow there's going to be a Twitter Spaces with me, Simon Dixon, and the Celsius Squeeze team. And we're going to find out who's lying. And we'll go over all those things. And of course, at the very end, we'll go into Q&A. But first, let's take a look at what's going on with Jerome Powell. Absolutely nothing. So Jerome Powell came out, or the Fed Reserve came out and said, yes, we were raising interest rates 75 basis points. And there's going to be a press conference, which Jerome Powell's going to come into and talk about why he did it. Not surprising. It's because inflation's crazy. And they want to get it under control and economy be damned. And that's what they're going to do, which is fine. That's fine. See how it all works out. I think they have to do those things. And if he comes in live, we'll talk about it and see where it goes. But the question I had was, well, how would that affect the markets? Because everything's priced in, right? Well, kind of. Actually, Bitcoin went up 0.8%. That's pretty good. Tether, nobody really cares. Let me see. Yeah. In the last hour, I should say, excuse me, Bitcoin did drop a little bit. Binance everything's down a little bit in the last hour. How'd that affect the S&P 500? Well, you can see right there, a little bit of a drop. I think, I don't know if people were not expecting that, but that is what it is. And also for NASDAQ, also a drop. So maybe that's your opportunity, not financial advice, to pick up some really cheap stocks and crypto for a second. But that's what's going on in the Jay Powell world. Let's take a look at what I think is a bigger issue. Stablecoins. And this new law that is in draft. Now, that is not to say that we have this is going to pass. Remember, this is just a draft. A lot of things can change from now until this actually gets passed by Congress. But this is what we have on the floor. And I will tell you, I think this is what we deserve. This is what we deserve because of Do Kwon and the shenanigans that were going out there. I'll explain in a second. So, draft stablecoin bill in Congress to require Fed and state regulator approval. Here's what it is. Here's the crux of it, really. I don't want to go over the whole draft. It's boring. But here's what it is. Stablecoins backed only by other digital assets created by their issuers would see a 2-year ban from new issuances. So if you got things coming out right now, you're good to go. However, moving forward, if you're not backed by anything, then you're going to have to do something with that, or else they're going to not allow you to operate here in the United States. With a 2-year grace period for existing stablecoins to receive approval after changing their business model. Draft legislation to create a U.S. federal framework around stablecoins would temporarily ban the types of payment coins that are not backed by outside assets, similar to Terra USD. So again, are we surprised this is happening? No. How many people lost a boatload of money because of the things that happened with Terra and their algorithmic stablecoin and the collapse that happened? The United States is going to have to step in. They did. They said, look, we could just allow that to happen and let the free market reign and just kind of go from there. And, maybe everybody would lose their money. And I know people right now are screaming at the screen and they're saying, Rob, you don't get it. Let him do it. Let him keep doing it. Let him keep doing it. Let all those things keep happening. And everybody's just lose and lose and lose before they get it, because that's what the free market does, right? That's exactly what could happen. Here's the thing. You could do that, but how many times are we going to let this happen? How many times are we going to let people lose out? And here's another question. How many people have a perfect memory of what happened 2-3 years ago? Right now, it's fresh in our minds because it just happened, right? I can guarantee you people's memories are like goldfish. They will not remember as things move down the road. They'll be like, well, it was a stable coin. There was this thing happened, but there's this new way we're going to do it, so it's going to be okay. Am I saying that this is the best way to do things? That's not what I'm saying. I'm just saying that this is the regulation that we deserve after the fiasco that was going on. So let's keep going. No non-bank issuers of stable coins backed by fiat currency would also be overseen by the state banking regulators and the Federal Reserve. That's a bummer. Banks or credit unions could issue their own stable coins. This is the funny thing. for these crypto companies that come out, they're saying, look, if you can do it, but it has to be backed by something. And if you don't do that, we're going to shut you down. Now, banks or credit unions could issue their own stable coins. I don't know why they would, but maybe they would, which would be overseen by the Office of the Comptroller of the Currency and the Federal Deposit Insurance Corporation. Because here's what I'm thinking, what's going to happen as time goes on. People will just issue their own stable coin. It'll collapse, and they'll take their money, and off they go. And then people will be like, oh, I'm not going to fall for that. And then there's a next wave of guppies come in, and the same thing happens to them. And it happens over and over and over again. Here's my question. What's the problem with just going, yeah, we're backed. We have everything backed. We don't have it just like out in thin air. Here's what we have. Here it is. And then, so let's just keep moving. I don't know. The current draft bill under negotiation between House Financial Services Committee, Maxine Waters, and Republican Rep. Patrick McHenry, at least it's bipartisan, would create a 2-year ban on stablecoins that aren't fully backed by cash or highly liquid assets like the U.S. Treasury bonds. And the question is, what is it being backed by? And the next question I had, and that would lead me to the thumbnail that you saw, was with Tether. Like Tether, I was always a little bit shaky on it. I know some people love Tether, they use Tether all the time. They think it's the greatest thing of all time. It's great, fine, go ahead, use whatever you want, I don't care. But I know there was an audit. I know it was done by an auditing company in the Cayman Islands, and apparently everything's on the up and up. Now they're going to have to go through a lot more rigorous steps. Am I saying that they bypass anything? No, I'm not. I'm just saying it'll be interesting to have more than one set of eyeballs on all these different books to see what actually is reality and what's just out of thin air. I just don't see it. Like USDC, Allaire, the CEO, went before Congress to go, look, everything is backed. And here's the documentation that you possibly need. Here's our bank accounts. Go ahead and check it. Binance Coin, BNB, I didn't know this till I did a story about 2 weeks ago. They're 100% backed by cash and assets and not just some kind of stablecoin thing. So if it's okay for them to do it, why is it, well, we'll just let the other guy slide? I just don't see it. Correct me where I'm wrong in the comment section. That's fine. That's what we're all here for. And then the question I have to ask you is, like, how many times are we going to get hacked and pulled before we all wake up? Here's another thing. There was another hack yesterday or today or sometime. I can't even keep track. Winter Mute lost 160 million of people's money, making it come to number 5. Look at this. We even have a leaderboard for hacks on our 2022 DeFi exploit leaderboard. Well, that's something to be happy about. So far, for total losses, I guess this is in 2020, the last 3 years, but really 2021, 22. We've lost quite a bit of money. We can see here billions of dollars. And here we are in Winter Mute. They just lost $160 million. My question is this. How many of these are real hacks that really happen with hackers? And how many are just rug pulls and people just coming behind it and going, you know what? We'll say it was a hack and then we'll take these hundreds of millions of dollars because it's crypto. Who knows? I have serious questions about all these protocols, all of them. And then not to be outdone, I will give the benefit of the doubt. So Winter Mute, this is their wishful cynic. He is the founder and CEO of Winter Mute. And he goes, hey, to the hacker, we offer a 10% bounty on funds taken. To make it easy, we propose for you to transfer all the funds taken to the exploit, save for $16 million. So you can keep the $16 million, I guess. Thanks for returning everything. Well, I mean, that is one way to do things. So that's what's going on in the world of stable coins and my 2 cents. Let me know what you think in the comments. We'll get into that in Q&A. And let's talk about some good stuff, huh? Cardano, the Basel upgrade is tomorrow. And I think everybody who owns Cardano is excited. Everybody who hates Cardano hates this day. It's just how it is. So just a reminder, it takes place tomorrow. It's set to take place over 5 days. I didn't know that. With the first round of upgrades scheduled for tomorrow and the second on September 27th. And this is from Charles Hoskinson. He says, we don't anticipate there will be any issues, but there's no going back now. No amount of testing or anything can save us. It's either going to hit orbit or it's going to explode. That's one way to say it. Hopefully it works out. And here's what it does. Basel will enable applications built on Cardano to become faster and more sophisticated, making the blockchain easier to build upon while improving the user experience. I got to tell you, I use Daedalus wallet, I have no problems. It's just that it takes a long time to download. It also improved the network's scaling capabilities through pipelining and lower transaction fees. I like that. But not to be outdone, hard fork was originally scheduled for June 29th, but suffered from 2 delays to allow for more testing and patching issues. Well, thank God they did that. Isn't that the whole point of the testing? So I'm happy they tested and they figured out, hey, this is not going to work. Let's push things back. At least they didn't push it back like 2 or 3 years. Just saying. Anyhow, what you think about that in the comments? Let's finish up with a little Voyager auction news. So, if you didn't know, Voyager is in Chapter 11 bankruptcy. And there's a couple of big players that came out that were in the lead. And apparently, and this is just hearsay, this has not been officially reported, but crypto exchanges Binance and FTX have both bid roughly $50 million for Voyager's assets. A little confusing to me. But just so you know, neither offer has been accepted. FTX and Binance were in the hunt to acquire Voyager's assets in the bankruptcy auction, which was held last week in New York. Final results of the auction are expected to be announced on September 29th, but that's not true. It's actually going to be announced. This is from Patrick Ackerman. Looks like the Voyager sale announcement has been postponed from September 29th to October 19th. So we won't figure out anything until next month. But the thing that confuses me is this. Oh, hey, real quick. We'll get to that in a second. This ought to be good. We're going to finish up anyhow. The thing that confuses me is about this. So as far as assets, and this is from the Voyager committee, the total cash is $104 million. Total crypto loaned, excluding 3AC, is $470 million. Total crypto held is $685 million. So the total crypto held and loaned is $1.2 billion. And they just got all this for $50 million? I don't know if that's just to acquire the company and then to make different parts of the people whole, or exactly how that's working. And I couldn't get any definitive answers from anybody. So if anybody knows anything, let me know in the comment section. And then lastly, before we listen to Jay Powell, I'm going to be on a Twitter Spaces, which I really don't like those things, but whatever. It's going to be me, Simon Dixon, and the crew from the Celsius Short Squeeze, Otis. And there's been a lot of back and forth, stuff like this. People accusing Simon like he's got his own agenda. What's your plan? Where's your plan? Have you submitted your plan? And he's like, hey, there has to be exclusivity. Celsius Network has to do their thing first, then I can do it later. So there's a lot of back and forth about people saying, you're a liar. No, you're a liar. So I brought these two guys together and we'll talk about who's lying and we'll go from there. And then lastly, before listening to Jay Powell, remember Puerto Rico is still underwater. There's a lot of problems going on, variable issues for electricity. If you could help Puerto Rico, there's 2 parts. First option, there's a link in the description, twitter.com, Ana Maria, and then also Protechos to start rebuilding those roofs because a lot of them got ripped off and people can't even live in their houses. So that's what's going on right now. Whoa, I just blew past that one. Let's listen to a little Jay Powell and what he's got to say and go from there. This ought to be interesting. Share my tab. Aha. Let's take a listen.
Back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage points, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer run normal level. Inflation remains well above our 2% longer run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you
One second.
how you?
Okay. So that's pretty much it. I mean, look, we could listen to Jay Powell all the time, but I think we got the gist of it, what he wants to do. He's not going to stop until the job is done. They want to hit 2%. Whether they make it or not, I have no idea. There's three things that they actually want to see. They want to take a look at supply and demand. They want to make sure that the inflation rate is starting to actually decrease, and the things they're actually doing are working. So until that time happens, which I don't see that going down, and we just saw the CPI numbers, especially core inflation, go up, or month over month, I guess, it's probably going to keep raising. So the question then is, what are we going to have until the end of the month? And I think, let me make sure that I'm not talking out of my left side. September. Okay, I was wrong. So there are a couple of more meetings. Let me share my screen. Coming up. So right now, they just got done with the September 2021 meeting. You're going to skip October. Hey, October's out. And then you get November 1st and 2nd. Remember, those are midterm times for America, was they start to vote in or vote out different members of Congress. And then another one, December 13th and 14th. So along that time, expect more rate hikes. Will they go 100 basis points, 75 basis points, 50 basis points? No clue. But like he said, and it was interesting what he said there. He goes, hey, we're going to make this or continue this on into 2023 and 2024 to maybe we can taper off in 2025. That's Jay Powell talking, not me. And of course, if you want to fight the Fed like Ben talks about, go right ahead. That's not my game. I'm just here to accumulate little bits. And that will take care of today for the news. So look, thanks for stopping by and hanging out with me for 25 minutes. Well, me and Jerome Powell hanging out with us. So that's great. But that's it for the news. If you want to stick around, I'll answer everybody's questions the best of my abilities, and we'll go from there. If not, take off, you hit the like button, subscribe, sure, and we go from there. But thanks so much. I appreciate it. Now let's get into a little Q&A. And let's see what we got.